Business uses of life insurance. By the end of this lesson, you should be able to discuss the uses and funding of key employee life insurance as well as buy-sell agreements, describe group life insurance and how benefits are taxed, and explain split dollar life insurance. Life insurance is frequently used as a vehicle to underpin a variety of business needs: key employees, funding buy-sell agreements, rank-and-file employee benefits, as well as executive employee benefits. When key employee insurance is brought up, most small businesses depend on that personal service of a key employee. The death of that key employee can significantly impact the business. So key employee life insurance is often purchased on the life of a key employee to cover the possibility of an income loss resulting from the key employee's death. Now, the company is the beneficiary in key employee life insurance. So they may take out a few $1,000,000 policy. It provides two main benefits to the company upon the death of the key employee. One is funding for continuity of operations, and the second is money to recruit a equivalent amount of talent from the labor force to bring them into the company, attract them to it, so that the success of the company can be carried on. So it's also used in closely held corporations to redeem their share of ownership of a majority stockholder upon the death without overly taxing the assets of the corporation. Now, term insurance is suitable if the sole purpose of the insurance is to replace the income loss that would have resulted from the employee's death. Permanent life insurance is more suitable if the objectives are to replace the income loss that would result from the employee's death and provide a retirement benefit to the key employee upon retirement. The premiums for key employee life insurance are non-deductible, and the benefits received are tax-free. Now, if the premiums were deducted, then that death benefit would be taxed, and you don't want to be in that situation because it's a negative leverage. You're trading a small amount, the premium, for a large amount, the death benefit. So again, we do not want those to be deducted as a business expense so that the resulting benefit will not be taxed. On buy and sell agreements, life insurance is frequently used as a funding vehicle for them. Buy-sell agreements are used in small business to control an orderly transition of the business upon the death of an owner. They may be between the partners in the partnership, between a stockholder and the corporation, or between the employees and the sole proprietor. A common example of a buy-sell would be when you have two doctors as partners and their spouses are non-doctors. Well, if one of the partners was to pass on in a community property state, the non-doctor spouse would be half owner of that medical group. And you can't own a medical group if you're not a doctor. So it creates a problem. You have an ownership interest of something that legally you cannot possess, and the life insurance can solve that by a pre-arranged agreement, whereas the surviving partner has agreed in writing to use those proceeds to cash out the surviving spouse of the decedent doctor, so that the value of that predetermined is settled immediately to the surviving spouse, and the surviving doctor now has 100% ownership. They didn't have to leverage out the business, seek out a loan in order to cash out the surviving spouse. So it's a very efficient mechanism for that. So we have a few different types of buy-sell agreements. One is the entity agreement. The entity enters into agreement with each owner specifying that, on the death of an owner, the firm will buy the deceased estate and sell the business the interest of the deceased. This was what we basically talked about in the last slide. The firm carries life insurance on the owner or owners, which provides the funding for the agreement. Next is the cross-purchase agreement. Each partner or stockholder will carry life insurance on the lives of other owners. Each partner or stockholder is both a seller and a purchaser, and the agreement provides that, on the death of one owner, his or her estate will sell, and the others will buy the deceased interest. Cross-purchase gets very complicated when we get to more than 3 owners, because if there are 4 owners, for example, each owner would have to purchase 3 policies on the other owners. So we'd end up with 12 policies. On 5 owners, we're ending up with 20 policies. It gets very complicated. So when we have a bunch of partners, typically the entity is the most efficient, 1 policy per life. Cross-purchase is most efficient when there's only 2 partners. We also have the sole proprietor agreement. where the sole proprietor enters into agreement with his key employees that requires his estate to sell and the key employees to buy his interest in the sole proprietorship. Key employees buy life insurance on the life of the sole proprietor, which is used to fund the agreement. Shifting over to group term life coverage, it's a benefit provided by an employer to a group of participating employees. And it's Section 79 of the Internal Revenue Code that governs these plans. The premiums for these plans are generally tax deductible by the employer, and the benefits not exceeding $50,000 are tax-free to the employee. Benefits in excess of $50,000 are taxable according to the tables published by the IRS. So here's how that works. If my employer provides $200,000 of group term life that I can purchase, I purchase that and I receive a $200,000 benefit, I also get at the end of the calendar year, or the end of the tax year, which is usually the calendar year, a 1099 for the premium value of the $150,000 beyond the 50 to make the 200,000. And again, here's an example of what we just talked about. How much income would an employee age 52 recognize for a 150,000 term life policy? In this example, it'd be 100 times 23 cents, the assumed premium, times 12 months. So fairly straightforward on that. Split dollar insurance. Split dollar life is a form of permanent life insurance frequently used in an executive compensation benefit. In a traditional plan, the corporation contributes an amount equal to the annual increase in the cash surrender value, while the executive pays the remainder of the premium. This is typically used for the upper echelon of a corporation. It is a way to shelter and leverage dollars that can be used for retirement, or if the employee dies, for their death, that are not subject to ERISA rules. So again, the death benefit of split dollar life insurance agreement is split between the executive and the corporation as follows. The corporation receives a return of its contribution equal to the cash surrender value, and the beneficiary named by the policy owner receives the death benefit. Some benefits is that the advantages of split dollar life is that the employer can provide higher life insurance benefits to key employees on a discriminatory basis with little impact to corporate earnings. So again, that discriminatory basis means it's not subject to ERISA rules. So to sum up, we've discussed some key employee life insurance concepts, buy-sell agreements, group life, and split dollar life. Thanks for your time.